Okay. All right. Let's do this. So, again, to preface this, I'm definitely not a financial advisor. I am a tax preparer. I do deal with this a lot, but again, not in a role of an advisor. So, the point of this presentation is to make sure that you at least know the right questions to ask of your tax preparer or your financial advisor or myself if you want to do it separately, and then get you on the right track. Everyone's situation is unique to the next person. All the time we deal with, my friend said this, my friend did that. So just understand that the person sitting right next to you might make the same money as you, but their situation at home, the way their withholdings are set up, whether they're in business or not, it could all be different, and it could set you on a different track. So again, just know what questions to ask at least, and that's what the purpose of this is going to be. So on that note, let's get started. If this will work. All right, awesome. All right, so the game plan for today. Just going to go over the most common types of retirement accounts, both employer-sponsored and self-directed. I'll break down each class. We'll compare some of them, go over some strategies. I do have a little bit of bonus content in the form of some additional investment and strategies for retirement that are tax sheltered. And then we'll do a Q&A at the very end. So once again, if you could just write down your questions and ask them at the end, that would be awesome. Appreciate it. Just somebody speak up if you're not seeing my slides or it's not changing. All right. So most common types of accounts. From left to right, we're going from employer-sponsored into self-directed. So your 401k, your Roth 401k, the 403b, the 457b, those are your employer-sponsored plans. So that's something you're going to get through your job. And then we have the traditional and the Roth IRA, which is something that you go and sign up for on your own generally. Okay. So a little bit loaded here, but I will go through everything. Let's do the left column first. So the 401k, the 403b, and the 457b function the same in many aspects. There are some differences, and I'll bring them up on a following slide. So the first thing you need to understand is that these are pre-tax contributions. So you're at work, you have a salary of $1,000 that's going to be paid on this paycheck, and you have a contribution of $500 going out into your 401k or 403b or 457. And that means that $500 goes straight in, and on your other $500, that's what they calculate your income taxes on. That's how these accounts all work. Therefore, your growth is tax deferred. Everything you set aside, everything your employer sets aside, and for whatever amount that money grows over time, when you start to withdraw it in your retirement, you will pay income tax at whatever your tax bracket is at that point, whenever that's going to be on that money, on those withdrawals. Okay, currently for 2020 and 2021, the yearly contribution limit that you can make is $19,500. If you're over the age of 50, you can do what's called a catch-up contribution of $6,500. So for a total of $26K altogether for the year. Your employer has the option to match a certain amount of what you put in. So some employers will match 1% of your contribution. Some will do 3%. Some good employers will do 10%. That's something that you look at your contract for, and you figure that out with them. If you choose to withdraw any money from here prior to the age of 59 and a half, in addition to the income tax that you'll pay on your tax return, you'll also be assessed a 10% penalty. There are some exceptions to the rule, and I'll go over them in a little bit. For these accounts specifically, after the age of 72, you have what's called required minimum distribution. So there'll be a calculation done by the plan sponsor based on your life expectancy and the value of your account. And every year you're going to be required to take these minimum distributions. Cool fact about this is if you have a lot of money, you have nobody to leave it to, the way to avoid paying income tax on that is to just defer them to a charity of your choice. That's these plans. One other thing that you need to know about these plans on the left side is that for the 401k and the 403b, in the rare case that you're offered both at work, that $19,500 yearly contribution limit is for both of them together. So you can't do 19.5 to one and 19.5 to the other. However, You can do a combined 19.5 to those two, and then the 457 has its own limit. So you can also do $19,500 there. Again, it's not extremely common that your employer will offer all of these or a multiple of them, but it's possible. So you should be aware of these things. Now the Roth 401k. Don't hear about this one often. If your employer offers it, I say it's a blessing, and that's what I would be preferring to put money into. The Roth are post-tax contributions. So you will be assessed income tax on your paycheck for whatever your total gross amount is. And after that, money will be set aside into the Roth 401k. The beauty of this is even though you pay tax on it today, over the next however many years before you pull this money out, whatever the growth that you have there, be it 50% or 100% or 10,000%, this is going to act like an ATM machine in the future. You just pull money out and get on your way. There will be no income tax on it. That's the beauty of the Roth. Same contribution limits as the other guys, 19,500 for the year, and 6,500 catch up if you're over the age of 50. Your employer can also choose to match. Some of them do, some of them don't. Their same penalty rules apply. If you withdraw prior to the age of 59 and a half, there will be a 10% penalty. Also, required minimum distributions for the Roth 401k specifically, required minimum distributions after the age of 72. I'm sorry, and I missed this on the other ones. Unless you are still employed by the same employer that sponsored that plan, you could be 75 years old. If you're still working for them, you're not required to take minimum distributions if you don't want to. And a rule specific to the Roth is that in order for your withdrawals to be tax and penalty free, even if you start that account at 57 years old and then hit 59 and a half to avoid those penalties, you must have that account active for 5 tax years for it to go through. And I'll cover what tax years mean when we get to the end of this presentation. I'll let you know. That's it for this. I'm going to move on. Okay, so differences of the 403B from the 401k. 403B, you'll find mainly in public schools and other tax-exempt organizations. So you can be a teacher, school administrator, a doctor, a nurse, some form of government employee, professor, and there's a few others. Those are the people who will see a 403B offered. It's in most ways the same as the 401k. There often are slightly more limited options of the funds that you can invest your money in, which is important to note. And they normally have shorter vesting time requirements. Vesting is if your employer chooses to match your contribution to a certain extent in your contract, and it's different with every employer, it'll say you must be employed with us for 6 months or 1 year or 5 years before you have the rights to the money that we're matching for you. So if the vesting rules are 5 years and you work there for 4, you're entitled to the money you contributed, but the money your employer contributed, they can take back. And then the 403B, the cool thing about it is there is a potential for additional catch-up contributions on top of that 6,500 if you do 15 years of continuous service for the same employer. So you can do another 3K a year or up to 15K for your lifetime. And that 50-year rule doesn't apply. So if you started at 20 years old and now you're 35, and for those 15 years you work for that place, you can do these catch-ups. Those are the notable differences between these two. Next, we have the 457. Also going to talk about the differences between that and the 401k. So one more time, just to remind you, it's a non-qualifying plan, meaning that the contribution limit of 19.5 is separate from the 401k and 403b. So you can essentially double up and throw a lot of money at your retirement if you're making enough to do so. No early withdrawal penalties on them at all. Also offered by state and local public employers. And then what else do we have here? Okay, covered that. And okay, so you can contribute 100% of your salary, obviously not to exceed the limit of 19,500. So there's no limitation there where there is on the other plans. Sorry. Okay, quick breather, just it's a lot of information just to take a break and just to remind you to, again, please write questions down and always consult a pro. Don't TurboTax this type of stuff, because every aspect of your life can cause a different situation in the tax world, and the retirement plans tie into that. Sometimes it doesn't necessarily make sense to go into a Roth IRA or a Roth 401k and not reduce your taxable income. Some people can reduce their taxable income with a regular 401k or a regular traditional IRA and qualify for some tax credits like the child tax credit, educational tax credits. So this is why it's important to always talk to a financial advisor or a tax planner or a tax advisor on this type of thing, amongst all these other things that are involved. So I just wanted to remind you guys of that. Okay, into the self-directed, what we call IRAs, the traditional versus the Roth. So here's what's similar about them. They both have the same contribution limits, which is $6,000 for the year, $1,000 catch up if you're over the age of 50, for a total of $7K. The contributions are limited to your earned income, meaning that if you just had unemployment this year as income, you cannot contribute to these plans. Unemployment is not earned income. You have to have a job. You have to earn income from there in order to contribute to these plans. So that's something to keep in mind. No age restriction on contributions, meaning that your kid can contribute money to this, right? They could be 14, 15, 16 years old, 8 years old if they work for you in your office and you have a business and they could actually do some substantial amount of work. They'll be able to contribute to a Roth or traditional IRA. These generally have a much wider variety of, sorry for the typo there, of investments that you can make, ranging from EFTs to stocks to whatever you want, pretty much. And important thing specifically with these, so with the 401ks and the 403bs and everything that goes through your employer, you're making contributions on your paychecks. You have until December 31st, until the end of the year. With these self-directed IRAs, you have until the original due date of the tax returns, which is normally April 15th, 16th, 17th, 18th, if it falls on a Monday. These last 2 years, it's obviously been different dates. But the reason that I exclaim this is that you want to wait oftentimes until you're getting your tax return prepared to figure out which way is best to go for you for that year. How much should you contribute? Should you go all traditional, all Roth, a little bit of both? Try to see where the tax advantages are for you. It's not extremely common, but I do personally get clients for whom we have to analyze this at the end of the year and see where they should throw some money, and we actually get to save them hundreds and sometimes thousands of dollars on their tax returns. So please keep that in mind. You have until the due date of the tax return, the original due date, no extensions. Sorry. Okay, the differences between the two. So the traditional, much like the 401k, is pre-tax contributions, all right? So most often people will receive a tax deduction on their tax return for the amount that they contributed to their traditional IRA. There is generally no income threshold, with the exception of if you are offered a plan by your employer. And on the next slide, I have a chart there that you just saw for a second, and I'll show you what those limitations look like. There are otherwise no limitations in terms of what your income is for the year. It does have the potential to reduce your taxable income to qualify for certain tax credits. That's what I mentioned earlier. It could throw you into a lower tax bracket as well. And then there are 10% penalties on withdrawals prior to the age of 59 and a half. And they also have the required minimum distributions after age 72. Now the Roth. The Roth, as we mentioned earlier, are post-tax contributions. Okay, so you get your paycheck and then you throw money into this Roth and you call it a day. There are income limits that apply for you to be eligible to contribute to a Roth because of the crazy tax advantages that it provides you. And for 2020, these are actually 2020 numbers, I believe. So I apologize about that. It's 124K if you're single, as far as your gross income on your tax return is concerned, and 196,000 if you're married filing jointly. For 2021, they just went up by $1,000, so 125 and 197. The cool thing about the Roth is that sometimes you'll hear it called as kind of like an emergency fund, because anything that you contribute to the Roth, right? These $6,000 a year, if you're the max, you can pull that out at any time. 5-year rule does not apply. No rules apply. You will not be taxed on it, and you will not be. So, if things hit the fan, you will be able to get into your Roth and pull that money out that you contributed without any implications. On everything else, there is a 10% penalty if you withdraw prior to the age of 59 and a half. And this 5-year rule applies again, and I'll give you an example. So I'm 58 years old, and I contributed $6,000 to my Roth this year. I'm going to contribute another $6,000 next year when I'm 59. When I'm 60, even though I'm over that 59 and a half mark, if I withdraw that money, I will be taxed on that money again, because I will be penalized on that money because it was not in the account for 5 tax years. To explain how the tax years work, so it's 2021. I opened an account this year. I'm going to contribute money on April 15th of 2022 for this year. So this means that from January 1st of this year, when I opened the account, 2021, I count 5 years. So we're going to January 1st of 2026. That's when I'm eligible to start those withdrawals to avoid penalty. Okay. So essentially, you can have the money in your account for like 3.5 years, a little bit more than that, before you can take it, if you set things up properly, if you're opening a Roth up in your later years. Another cool thing about the Roth, no required minimum distributions ever. You can take this thing to the grave if you want to. That's that over here. And this is the chart I was talking about. This is just a general chart, so you side, but I'll focus on the right side here. So you see on the top right, the traditional IRA, when you are also covered by an employer, 401k, 403b, etc. Okay, if you're married, filing jointly, and again, these so just bump them up by $1,000. And if you're married and you file jointly and your income exceeds 124,000, you will not receive the tax benefit on your income tax return for that contribution. And if you're single, $75,000 and so on. And those are just the limits for the Roth there as well, which I just that's pretty much it there. The other stuff, please feel free to use this chart. Those rules do apply on all the rest of these sections. Another chart here, things we already covered. On the left side, you have 1K, 4B, 457 goes there as well. $19,500 this year is your contribution limit. And then if you're age 50 or over, you can put in another $6,500 for a total of 26K. And that's that here. Again, I just gave you a little bit of extra information for you to utilize as you please. Okay, so this is something that we all hear about. Nobody knows exactly how it works. It is a little bit complex sometimes. So because the Roth has those income limits, right? If you make more than a certain amount of money, you can no longer contribute directly to your Roth. But you want your money there because all that growth that you're going to receive, like if you're 30 years old like me, for the next 30, 40, 50, however many years, I hope it's going to be a lot of growth, even if it's at 10% a year. I want that in a Roth. I don't want it in a traditional or a 401k or anything like that. I do apologize about the sirens in the background. I was hoping that wouldn't happen. So what we do in that case, there's something called the backdoor Roth conversion. So this year, I'm preparing my taxes, and I find out that I cannot contribute directly to a Roth. I'll get penalized if I do so. So what I do is I contribute my money to a traditional IRA, and then from there, I convert that money to the Roth, and I will pay income tax on the money at that point. All right, so I'll get the tax benefit from the traditional IRA, but then it'll be reversed because I'm converting to a Roth. Then my money's in a Roth. Another way that you can get money into your Roth is you left your job, you have 401k funds sitting around. You can call up that 401k servicer. You call up your Roth IRA servicer, put them together. You will be able to move money from your 401k to your Roth, pay the tax on it, whatever it is. And when you do the backdoor Roth conversion, the beautiful thing is that $6,000 limit doesn't apply to you. You can convert as much as you want. This is one of those super specific cases where you want to talk to an advisor because you want to make sure you're not starting to jump tax brackets and pay too much. So want to do a little bit every year, more in years where you'll have a lower taxable income, obviously. Okay. So really cool thing. Absolutely keep it in mind, please, and definitely ask questions about this. That's that. Oh, and I'm sorry, very important, the backdoor Roth conversion. April 15th is not the deadline. It's December 31st. It has to happen in that same year. Just if you're self-employed, so you know these, I'm not going to go over them today. The SEP IRA, the simple IRA, the solo 401k, they all have their own benefits. They all have their own drawbacks. Definitely speak to an advisor when you're doing this type of thing. Don't just go on fidelity.com and start opening things. This is the second to last slide here. So we're almost at the end. I'm sorry for dragging you guys through this for so long. The retirement savings contribution credit. Appears that many people don't know about this, but you should know about it. The kind of like layman slang term for it is the saver's credit. That's how you'll normally hear it. So this is a credit that's reserved mainly for people that report low gross income on their tax returns. So you could still be a wealthy person, you have real estate investments or any kind of other investments. They just don't draw gross income for you, on the front end. And you may qualify for this. So you must be 18 or older to claim this credit. You cannot be a dependent of somebody else for that tax year. And you can't be a full-time student for any part of 5 calendar months during the year. If you contribute to a retirement plan, and pretty much all of them are eligible for this, you might get a credit. The chart on the right shows you that, right? So if let's just talk about married people for argument's sake. If your gross income is not more than $39,500, obviously a very small amount, but there are people who fall into this category. 50% of your contribution will go as a non-refundable tax credit to you. Non-refundable meaning that if you owe tax on your tax return, this will bring it down as far as zero, but it won't generate a refund for you. It will still help though. And you go down the list here. I'm not going to go through every box, but you can always refer to this. I'll send you guys the slides later. It's a good thing to know. Ask your accountant about this. Ask your TurboTax about this, and get it done from there. Last but not least, the couple of bonus investment vehicles that are tax sheltered that I promised to tell you about. And I should have emphasized this from the beginning. Everything I spoke about today in terms of income tax, federal tax purposes only. I'm not covering states because there are many of them. They all have different rules, different boundaries, different everything. So with states, either reach out to me directly or reach out to your advisor directly and ask them how it applies. So the 529 college plan, not all states offer them, but definitely take a look and check with your state and see how that goes, see if you're eligible for it. Basically, this is money that you can set aside where you will receive a tax deduction on your state income tax return, potentially. Okay, so the money will be partially tax-free that you contribute here. And then in the future, when whoever your beneficiary is, whether it's your child, your grandchild, niece, nephew, you contribute from anybody. Once they go to college, you can pull money out of this account to help pay for the tuition. Whole life insurance policies are a huge one. A lot of people don't know about this. There are 2 types of life insurance policies. There's your term life insurance policy, which is only a death benefit. Whatever the policy covers, your beneficiaries will receive it if you pass away, if and when you pass away. A whole life insurance policy carries a cash value. So there is a death benefit, but there's also a cash value benefit. You contribute money here every year. I think the most average ones are 20-year plans. So you have a plan for 20 years where you contribute, let's say, $1,500 a year, $2,000 a year. They do grow with the market. Most of them have a return somewhere between 10 and 15% on average. Your advisor will show you a schedule of how your money should grow in there. And then at a certain point, you can pull that money out completely tax-free. It's post-tax money that you put in there, but the money will grow tax-free at those rates that I mentioned. So 100%, if you have the extra dough lying around, do this. If you do this for your young kids, like your 5-year-old, your newborn, I mean, you're going to pay like $10 a month, $20 a month for them to have something for college or for marriage or whatever you want it to be for by the time they're 18. And lastly, HSA, FSA account. If you're employed by someone that offers this, you know what it is, right? So this is money that goes pre-tax, a certain amount of money into an account for you that you can only use on specific things like, co-pays for your doctor's procedures and so on. So that's pretty much it. I want to definitely thank you guys for taking the time to listen to me. It's the first time that I did one like this live this long, so I hope it went well. Thank you, Nick and the Unrivaled Options team for letting me do this. I definitely think there was some good information for everybody, and